$200 silver. Say it out loud and you can feel the room split instantly. Half the people laugh, half the people start chanting like it's guaranteed. Both groups are reacting to the number. Neither group is asking the only question that matters. What set of conditions would make $200 not a meme, but mathematically plausible? So one word only in the comments right now. Pick your camp. Math if you think the conditions are lining up. Mirage if you think this is mostly narrative and it fades. Math or mirage. No edits after the retest. We grade it. Quick guardrail. I don't sell signals, mentorships, or memberships. This is educational. Different feeds print differently. I'm not claiming certainty. I'm mapping conditions and the tells. Now, you gave me two sources. I can fully access the CBS News piece, and I'm going to extract its core claims and expert quotes precisely. The Yahoo Finance link is currently rate limited in this environment, 429 error, so I can't pull or quote the text directly from Yahoo right now. I'm not going to guess what it says. I'll build this script anchored to CBS and keep the 5 forces framework tight and defensible. If you paste the Yahoo article text later, I'll stitch its specifics in the same OG pacing without changing the structure. Here's the CBS material, clean and factual. CBS says silver ran hard over the last year. Silver went from about $30 Aussie to over $100 Aus during the run-up, and by Feb 9, 2026, it had cooled to just under $80 Aus, with the drop partly due to profit-taking and investors reassessing the economy and inflation. CBS also says the underlying drivers remain. Supply still tight and investor demand still strong. Then CBS asks experts, could silver hit $200 per ounce in 2026? Their overall framing, experts generally think it's not likely in 2026, but possible under extraordinary conditions. Now listen carefully to what extraordinary means in the CBS piece. Peter Reagan, Birch Gold Group, says $200 silver by 2026 is certainly possible, but under extraordinary conditions, likely requiring an extreme decline in currency values or an extreme increase in inflation. Vince Stancioni says he sees $200 silver and $7,000 gold likely before the next U.S. elections, NOV 2028, but that would probably mean significant currency devaluation. Brett Elliott, AppMex, says $200 won't happen with a minor disturbance. It would need something intense to generate another parabolic move. He gives the example of something like a major exchange defaulting on its contractual obligation to deliver silver. And CBS adds the hard math reality check. From today's prices, silver would need to rally over 250% in 11 months to hit $200. And Elliott calls those historically slim odds. So $200 is not just bullish. $200 implies the system is stressed. It implies the market detaches from normal trend behavior. It implies multiple engines running at once, which brings us to your title, 5 converging forces that make it mathematical. Let's build that the adult way, based on what CBS actually says, and turn it into a checklist you can grade in real time, because that's the point, not believe. Grade. Here are the 5 forces. Force 1. Currency confidence breaks, inflation accelerates, or both. This is the most important force because it changes the why of the buyer. CBS is explicit. $200 silver in 2026 would likely require severe economic distress, extreme inflation, or currency devaluation. Translation. When money feels stable, silver trades like a volatile commodity with industrial demand. When money feels unstable, silver starts trading like a hedge, like a monetary metal, with torque. And torque is how you get parabolic moves. So Force 1 is not a headline. Force 1 is a regime. It's, do people trust paper? Because if you don't get some version of that, either inflation fear or currency confidence fear, the odds of a 250% move inside a year drop hard. Force 2, supply stays tight even as price rises. CBS says supply is still tight and investor demand remains strong. But here's the part people miss. Supply tightness only matters for price if it doesn't resolve. If price rises and supply responds through recycling, inventory release, or faster mining output, the market cools. CBS literally warns that an increase in price can increase mining and recycling, potentially limiting price increases. So Force 2 is not tight today. Force 2 is, tightness persists through rallies and through pullbacks. That's when the market stops mean reverting. That's when the quote becomes sensitive. Force 3. Investment demand surges again, hard. CBS says the drivers remain and investor demand is strong, but the price cooled as investors took profits and reassessed the economy and inflation. That's your tell right there. Silver's big moves are not slow. They are flow-driven. They require urgency. And $200 requires flow, because CBS is reminding you from under $80 to $200 in 11 months needs an explosive engine. So Force 3 is a renewed wave of investment demand, not a few people buying coins, a real wave, the kind that makes the market detach again. Force 4. Industrial demand stays strong and substitution fails. CBS says for silver to reach $200, you need an imbalance in supply and demand, increased investment demand, and strong industrial demand with limited substitution. That limited substitution phrase is everything because silver has a built-in cap mechanism. If it gets too expensive, manufacturers start thrifting and substituting. CBS says Elliott is already seeing industrial consumers looking for ways to substitute or thrift silver and mentions a story coming out of China. Development of silver-free photovoltaics picking up pace. That's the China component in your title, and CBS gives it to you in the bearish case. This is the knife edge. If industry can substitute and thrift successfully, demand pressure eases. If industry cannot substitute at scale fast enough, demand pressure persists. So Force 4 is literally a race. Can substitution catch up before the market reprices? Now Force 5, the one that turns a bull market into an event, a shock catalyst that forces a reprice. CBS says $200 would likely require extraordinary conditions, and Elliott gives the example of something intense like a major exchange defaulting on delivery obligations to spark a parabolic move. This is where war fits your title. War, geopolitics, supply chain disruption, policy shock, or a market structure failure can all serve the same function. They compress time, they widen spreads, they create uncertainty, they push people into hedges, they stress liquidity. And in silver, liquidity stress is where you get the violent repricing behavior. But I'm not going to do the comment section thing where we pretend one headline guarantees $200. CBS is clear, extraordinary conditions might create the possibility, but it's not likely, and it would come with serious economic distress. So now you have your 5 forces grounded in the CBS expert framing: currency, inflation regime, stress supply tightness that doesn't resolve renewed investment demand surge, industrial demand holds, substitution fails, an extraordinary catalyst that breaks normal behavior. Now here's the problem. Even if all 5 forces are possible, you can still get wrecked because silver is a savage instrument. CBS includes a warning. Stanzioni advises against leveraged ETFs or futures because higher volatility has caused many speculators to get killed. That's not a metaphor. That's what silver does. So here's the only rule that keeps people alive in stress regimes. First candle is chaos. Retest is the verdict. And that leads to the 2 tells that decide whether $200 is becoming math or staying mirage. Tell number 1, acceptance after the pullback. I don't care how vertical the first move is. I don't care how many people clip it. I care what price does after the pullback, because a parabolic move that becomes sustainable has a signature. It accepts above the decision zone. So here's the method. Use the 1-hour chart. Find the breakout hour where the market changed character, mark the body close of that hour, mark the midpoint of the impulse move. That band is the decision zone. Rule: I only respect continuation if, after the pullback, you print 2 hourly body closes holding that zone. 1 wick is noise, 2 closes is acceptance. Tell number 1, tell number 2, stress normalization. CBS isn't talking about spreads and execution quality because it's a mainstream finance article, but it's describing the conditions that would create persistent stress: currency devaluation, extreme inflation, intense catalysts, exchange delivery failures. Those are stress regimes, and stress regimes have a signature. Stress does not turn off quickly. In a normal market, after a spike, things normalize fast. Spreads tighten, wicks shrink, execution cleans up, tape smooths, physical loosens on dips. In a stress market, after a spike, stress stays on. Spreads remain wider longer, wicks stay long. Tape stays bursty, and physical doesn't loosen even when paper dips. That's tell number 2. Now let's run the 2 scenarios like OG style. Bearish first, bullish second. Scenario 1, mirage. This is the world CBS is leaning toward when it says experts aren't counting on $200 in 2026, and that a 250% move in 11 months is historically slim odds. In mirage, the rally attempts happen, but they don't sustain. Why? Because the drivers don't align long enough. Maybe inflation cools. Maybe the dollar strengthens. CBS explicitly says disciplined monetary policy and or an increase in the US dollar index can negatively impact demand. Maybe higher prices pull supply forward through mining and recycling. And maybe industrial consumers successfully substitute and thrift. CBS says this is already starting to happen and mentions China's silver-free photovoltaics narrative. So mirage looks like this. Silver spikes. Retail gets excited. Then the pullback comes and the decision zone fails. Stress turns off quickly. Premiums loosen, availability improves, the tape becomes normal again. Silver remains bullish long-term maybe, but $200 in 2026 fades. Scenario 2, math. This is not guaranteed. This is conditions align. CBS says $200 could happen under extraordinary conditions, particularly extreme inflation or currency devaluation. And it says a sustained move to that level would require multiple drivers aligning: imbalance in supply and demand, increased investment demand, strong industrial demand with limited substitution. And Elliott adds the idea of an intense catalyst like an exchange delivery failure creating a parabolic move. So math looks like this: inflation fear resurges or currency confidence weakens. Investment demand accelerates. Supply can't respond fast enough. Industrial demand stays strong and substitution lags. And an extraordinary catalyst compresses time and creates urgency. In this scenario, silver does what it does in late cycle moves. It stops lagging and starts leading. It doesn't move in steps. It moves in bursts. And after pullbacks, it holds acceptance. Stress remains on. Physical remains tight. That's when math starts to matter. Now, you might be wondering, why do analysts and experts always hedge? Because they're not selling you adrenaline. They're describing probability. CBS is very explicit. They say $200 silver in 2026 is possible, but would likely come with serious economic distress, and that's not something you casually wish for. So here's the honest take. If $200 silver happens fast, it's probably not happening in a happy world. It's happening in a stressed one. Now I'm going to give you the no terminal way to track this because most people don't do it, and it keeps you grounded when the screen is screaming. Pick one dealer you trust, pick one coin, pick one bar, track two numbers daily, premium percent over spot. Lead time. If a sell-off happens and premiums collapse and lead times shorten, stress is normalizing. If sell-offs happen and premiums stay sticky and lead times stay long, stress is not turning off. That's the physical tell. Now we close with what CBS literally recommends in plain English. They say silver is volatile and diversifying with gold can help cushion extremes, and they quote allocation examples like heavier gold with silver as an additive. They also list investment vehicles, bullion, ETFs, IRAs, while warning about leverage. So even CBS is telling you the adult lane version. Respect the volatility. Don't use leverage like it's a normal market. Don't bet your life on a meme number. Now 3 takeaways, and we're out. Number 1, CBS says $200 silver in 2026 is possible, but experts generally think it's not likely without extraordinary conditions, extreme inflation or currency devaluation, and they explicitly warn that would likely come with serious economic distress. Number 2, CBS says the conditions for $200 require multiple drivers aligning: supply-demand imbalance, increased investment demand, and strong industrial demand with limited substitution, while noting a strong dollar and disciplined policy can hurt demand and higher prices can increase mining and recycling. Number 3, CBS warns the biggest threat to a sustained rally might be silver's own success: industrial thrifting and substitution, including narratives about China pushing silver-free photovoltaics, and it includes a direct warning against leverage because silver's volatility can kill speculators. Math or mirage? Drop your word now, then come back after the pullback and reply to your own comment. Did acceptance print and did stress normalize or stay on? Accountability over hype.